Go. Hey, everybody, Economic Ninja here. I hope you're doing great. We're going to talk about the US dollar. We're going to talk about the euro, the comparisons between the two, but also there is a battle going on. That is, who is going to stop raising rates first? Will it be the Federal Reserve or will it be the Eurozone and the IMF? There's a lot of calls for the IMF and Christine Lagarde to slow down her rate of rise when it comes to interest rates sooner than later. And so I brought on Patrick Karim from Bad Charts. He's the pro. Let's look at the charts. And just so you guys know, you're all about to look like great white sharks about to feed. Why? Because everyone's eyes are about to roll back in their head. That's right, but in a good way. Because as you don't understand this right now, I want you to take some time and digest these charts. You may have to push the pause button and look at these charts that Patrick has because he goes really in depth. So with that being said, Patrick, how are you doing?
Hi, Mr. Ninja. I'm doing great. Always fun to come and catch up with you there.
Heck yeah. Well, let's jump into the charts because there's a lot of news right now. If you want to share your screen, and we'll dive into what's going on with the US dollar because it has to do with everything. The price of gold, silver, uranium, lithium, and even food.
All right, guys. So first, what you'll see on my screen, I have the DXY. It's the US dollar index. But essentially, guys, don't get too uptight. What's the US dollar? It's a basket of currencies against the US dollar, but it's mostly the euro that's in there. Yes, there's the Canadian dollar, the Australian dollar, the Swiss franc, the Japanese yen, they're all in there. But here's the DXY, and here I'll overlay for you the USD euro pair. And look, guys, it's practically the same. So for me, it's interchangeable. In my head, I know it's crystal clear. If somebody says DXY, I know we're talking about US dollar strength versus Eurozone strength. They're the two big boys in the currency pairs. So that's what we're dealing with, guys. But I'll minimize the USD euro just to not highlight that.
Real quick, Patrick, can I just jump in? For everybody looking at the chart, see that massive Christmas tree back from 1980 to 1980, let's say end of 80s. I want people to understand that that strength in that dollar value was attributed to higher interest rates, okay? It started with inflation getting out of control in the late 70s, Paul Volcker moving in, stepping in and raising rates aggressively. And so that's why you see that huge crescendo at the top and then it come crashing down because productivity had slowed down. And now if you can see just what we're dealing with right now in 2022, and Patrick, I'd love for you to explain the Fed funds rate, because if you look all the way over at 2022, that yellow line that's going straight up, that is the Fed funds rate and what they're doing with these interest rates affecting your mortgages, but also credit card debt, auto debt, student loan debt, and all that kind of stuff. So we're in a very interesting sort of precipice, wouldn't you say, Patrick?
It's look, I don't know how big this debt bubble could be, because you got to imagine, just like you said, the Fed fund rates multiplied by the total public debt is off the charts. I did a chart back. I think we even talked about it. I called it my total debt saturation chart. It's like we're at levels. If you multiply the Fed fund rate times the total public debt, we're at levels higher than the 2000 bubble. We're higher than a whole bunch, like historical. We've never been this high. So this, I'm just wondering like how much time is going to take for the damage to really be seen about this move up right here. And yeah, if you overlay the Fed fund rates by itself, you can kind of see that it attracts money, capital flows in the US dollar. So as the Fed fund rate goes up, people say, oh, I should be holding US dollars overnight. I'm getting interest rates. But you'll see this is part of the picture. You see correlations there, but it's not quite there. If you really want to understand what's fueling the DXY or the euro, why people should hold the US dollar versus the euro, what you have to look is at the delta. So the difference between the Fed fund rate minus the Eurozone overnight rate. And that's what I have right here. Let me just scoot that. Where is my here? It's this one here. I don't have data going back further, but I have another example we could show later for the USD dollar versus the Great British Pound. The delta. So if you're getting more interest rates paid by the Eurozone to hold those euros instead of US dollars, that's going to attract capital flows into the euro. And you see this one here, there's lags. But overall, when it goes up and down, it goes sideways. Now, as this line goes up, that means the Fed fund rate is outpacing the euro central zone lending rate. Then capital flows are going into US dollar, US dollar, US dollar. And see that drop here? When that drops ahead of time, then the DXY gets priced in. So now the overnight lending rate for the US dollar right here. It broke down versus the Eurozone in 2019. That's when gold shot up, a whole bunch of commodities shot up. And here it's going up. So I'm waiting for the next time. And I don't know, you might have some insight into that. When this line breaks down, that's when we could expect the DXY to really start plummeting versus the euro. But I just don't know.
Ironically, I've been calling for the Eurozone to collapse for the dollar, for the US economies. I believe the euro is going to go. And when it goes, because it's so closely tied, like you've been showing us here, that we have literally a matter of weeks, if not a couple months, before we start to see extreme pain in the US dollar system and our stock market. Now, something you had on the last chart, when you had the Fed funds line up, something that makes me, the hair on the back of my neck pop up, that yellow line, let's go back to 2001. When we see the Fed funds rate start to drop because of the dot-com bust, and they had to come in and spur growth. So they started dropping aggressively. What was interesting is what followed afterwards, the value of the dollar, correct?
That's right. Right after you see the Fed fund rates breaks down, the US dollar, it still has uphill momentum, but eventually that just topples over because you're sucking the life force of the DXY, right? Because if the overnight lending rate is not favorable and inflation is outpacing the Fed fund rates, then it sucks the energy out of it. And that's what happened after that. It just
So now this is what's interesting to me. On this chart, correct me if I'm wrong, I do not see, and going back to the 2022, a moment in history like this, where the Fed fund rate is aggressively going up and it's starting to take out the dollar's value. And so the dollar has started to show weakness as the Fed funds rate is increasing. Usually, like you said, it lags. The Fed makes a decision. It starts to move either lower or higher, and the dollar corresponds down the road. But as of right now, what are you looking at for the dollar value as the Fed funds rate keeps screaming up higher?
We could have something like this. So this could be the first leg down. I don't know if you see here when it starts spiking up and then it went down as I'm going to just put it here. It hadn't slowed down yet. So we can't say the DXY is dead yet. It's pulling back hard, but it's rarely, just as it's rarely the V-shaped recoveries upwards, it's rarely V-shape or I don't know what you want to call that, a pyramid down. It's gonna find some support eventually. I'm not quite sure where it is yet, but once it hits support, we might have a spike up in it, and then we'll know the truth. Will it spike up something crazy where nobody expect the US dollar to really outperform the euro? Or is it going to fizzle out and then consolidate sideways and then topple over like it did back in 2001? So we're not quite there yet. Usually I don't like judging the end of a run just based on the first drop, but the more drops, it creates a lot of damage. So it's telling me momentum slowing down. But before I go full short US dollar, I want to see it bounce, like, just I want to see that echo bubble bounce, and then I'll have more confidence in the new direction it's going to take. So we might have this type of scenario right here where it might bounce up. We'll see how high. Then after that, we're going to be like lions waiting in the savannah. We're going to wait for the prey to really start getting injured and tired. And then we're going to pounce and we're going to go massively long commodities, massively short the US dollar. But it's not quite there yet.
Now, another thing that's really interesting to me is when the Fed started raising incrementally from 2004 to 2000 and mid 2006, if you look at that rate of rise, it was pretty steady, nowhere near the trajectory we have now. But look at how much higher it actually got to. What was that, like 5.25% they got the Fed funds rate to?
Yes, exactly that.
And so to even imagine, can you imagine, Patrick, what would the world be like right now if the Fed funds rate was at 5.25 as opposed to, I want to say it's at 4.25 off the top of my head. Do you know what it's at right now?
Right now it is exactly at 4.1. That's right.
4.1?
Wow.
Okay, so how much would a mortgage be? What would the 10-year bonds be priced at if we saw 5.25 again? I actually would be shocked if they could get there and still hold everything together, but I do think they're going to try and get that Fed funds rate to touch 5%. What do you think, in your non-professional opinion, what would we see in dollar value if all of a sudden they get the Fed funds rate that high?
Well, what do you mean, the US dollar, if it's going to go up in value if they get the Fed fund rate?
Yeah, because a lot of people put so much value in the Fed funds rate, and they said, look, if the rate's getting that much higher, then there's going to be a lot more confidence in holding dollars because there's going to be potentially that much interest. But the thing is, we're already on shaky ground. We know the euro is on shaky ground, especially dealing with an energy crisis, and we're still right in the middle of winter right now. So the question is, where do you think that could you see the Federal Reserve being able to hold things together at a 5.25% Fed funds rate, or do you think that it's going to be an about face?
Man, we're like in uncharted territory, because when I look at analogs, it brings you back to the 1960s, where the rates in the 50s, 40s, 50s super low.
Yep.
And then they start climbing up. I'm pretty sure people had the same type of reasoning back then. Oh, it can't sustain, can't sustain. Yeah. But something's got the Fed spook. Seriously, for them to continue on this rate hike thing, like back, I said they're going to pivot, because we've been conditioned, brainwashed that they pivot, but they're spooked. And even the charts are telling me if I put the 10-year yields, we've broken out of 40-year descending channel. It's like there is inflation. The market's telling us there's inflation. There might be a seesaw, but we're going to do higher lows, higher highs. Right now, we're just doing the first, what do you call that there when you go down there? Draw. We're doing the first drawdown.
Yes. Let me ask you this. You used a perfect word, spooked. And we've been watching news stories about central banks around the world. I'm going to totally pull this out of the air. Sorry, Anya, but gold. Central banks are buying up gold like crazy. We're seeing people rush into gold. We're seeing gold premiums come down because it's almost like this lull, this calm before the storm, right? But the reason why people buy gold is as an insurance play. Where do you think, or what's the charts telling you about gold in reaction to what's going on right now with the Fed and the euro?
Well, I can tell you that gold is reacting to, I'll put it up real fast. Gold has spotted the bottom in CPI. Okay, let me put inflation rate.
No problem. I totally threw this on you. I apologize, but
no, it's fine. Really I have a chart for everything. It's just I need to. Gold loves to bottom when inflation rate. This is what's sad, because it's kind of the nature of the beast, because when inflation rate is high, that's when the media's talking about it. They should be talking about it back here when it's creeping up, where there's possibilities of the inflation rate starting to turn up. But people, they talk about inflation when the numbers are already high, and gold is leading. It sniffs that stuff out. It's intelligent. It's a financial metal. Gold broke out in June of 2019. Inflation was still heading down, but it sniffed these up legs in inflation. And right now, I did a chart. 5 times out of 6, gold actually bottoms exactly when the inflation rate breaks down. So I'm not quite sure about right here. So when gold is actually moving up, it's sniffing that inflation is about to turn up. In 3 months, 6 months, inflation is going to start going up. Yeah. But look, for that Fed fund rate, the impact on the US dollar, it all depends what the euro does. Because if the euro is able to outpace its overnight lending rate, and it's able to increase it while the US the Fed cannot increase it as much, then the euro will gain steam. So there's these moving levers which could change at which rhythm the US dollar moves versus the euro. But at the end of the day, they're just fiat currencies continuously depreciating in real terms. So that's why you got to look at the gold chart. Look, I'll show you a gold chart.
Well, here, real quick, I got to show them something real quick, if you don't mind. This is the thing that totally blows me away, and I want people to understand. Look at when the Fed started raising rates, and the price of gold, you just had it on there, started coming down a bit this last year, right? Fed started aggressively raising from the spring, and the gold price came down a bit. And now to see where we are, it's all right. We already missed it, but it's hard to say in that angle. But to see where gold is right now, even when the Fed is raising rates, I want to show people that a lot of investors understand that the Fed is about to break the back of the economy because they can't handle these high rates. And that's why I believe people are moving in to the gold trade, because it's the fear trade. Sorry, go ahead, Patrick.
Yeah, it's here. And when people are calm right now, well, that's exactly when gold, it's not when there's full panic, when everybody's panicking around you, everything's been priced in the markets. That's what's very vicious about the marketplace. It's so efficient that it's going to price in your fear before you feel it. And people, when they say fear, well, you have to prepare before. You have to prepare when the charts told you stuff was breaking out, when you had a chance to prepare. And if you wait for the news, guys, you're dead man walking, because you'll always catch it towards the end. Just like everybody jumped in cryptos when it was close to the top. It's the same thing here. Look, This is gold expressed in Great British pound. It's breaking out. If we
Yeah.
get a monthly close above this line right here, it is done. The gold is starting a new leg versus the British pound. It's about to break out. Maybe by the end of Q1, it's going to break out versus the US dollar. It's like the 2-3 year consolidation we had in the precious metals. It's practically done. It's sniffed out the worst.
Yep.
And now it's about to resume its uptrend. So
yeah.
Look at this. This is another one just before we move on. The gold in Great British pound broke out in May of 2019, 1 month before gold did in the US dollar. The gold in US dollar broke out in June of 2019. In Great British pound, it broke out 1 month before. So all these weaker currencies, these European currencies, they're front leading eventual weakness in the US dollar. It's
and as
really
I talk
close.
about it all the time, the reason why it broke out in May of 19 was because the banks were falling apart in 2019. And that's when the overnight lending rate spiked to 12%. Everyone remember that in September 2019. And then look what came a few months later. That's something you really need to watch for. This could be a monumentous event in 23, which I'm calling for higher gold prices. Actually, I'm calling for an all-time high, a new all-time high in this year. But that's, hey, not professional advice.
Well, it's definitely possible in the charts. So you got the setups there for the taking. I'm going to be screaming on the rooftops. You'll see me on Twitter go nuts there when we have a confirmed breakout. But we're closer. This is why people have to stop always panicking. Well, it could go down and deflation. Look, the market's going to tell you if there's deflation incoming or not. We had a deflation scare right now as gold was dropping. When people were talking about high inflation, gold was actually discounting the probabilities of us going to a deep recession right now. I think there's going to be a big recession or a big depression later on, but I think the fact that gold and silver and oil are going up, we kind of avoided the worst right now. As long as gold, silver is able to climb up right now, I think the worst is ahead of us. But the recession, if we had one right now, I think we're climbing out of it. They might backfill it and tell us we were in a recession for the past year, but I think that's probably past us.
Yeah.
But look, oil is about to go ballistic. Seriously, if oil doesn't crash right now, it's going to go nuts. It's about to go nuts. That's what the metals are telling. That's what oil's telling. That's what copper's telling you. They're going to price in the monetary imbalances that they'll have to do to save the markets, to save whatever they have to save, the money printing, whatever they're going to have to do.
Yep.
The commodities are going to sniff that out and price that out ahead of time. And
I totally agree.
Yes. And when people start talking about the next wave of inflation, let's say we hit 20%, even if the bamboozled CPI, whatever you guys want to call it, when people start talking about 20% CPI, the metals are probably going to be already topped out. They're probably going to be topping out for a year. Mm-hmm. But you guys, your viewers, they'll be in the know because they'll be ahead. They'll be prepared for the next move coming in, right? When I have like silver eyes, and I say, I keep putting rocket ships everywhere, it's probably going to be time to sell.
You're absolutely right. Well, it's very well that I'm glad you said prepared because we're all about being prepared, not scared. And in closing, can we tell everyone how to follow you?
Batcharts1 on Twitter, guys. All the free stuff's there. Go have fun. Go troll me or get the good information because there's a lot of good stuff out there. And
go troll me. I love that, Patrick.
I'm getting so many Bitcoin trolls. The Bitcoin's going up a little bit, and I'm the boogeyman. Like, leave me alone, guys.
That's all right. I still think we're going to see some hard times for crypto because of how tight it is to the equities. But hey, that's just me and you. So. Hey, with that being said, I thank you so much, Patrick. I want to have you on soon, and we're going to talk about oil, and I want to talk about, what is it? Oh, platinum. That's what I want to talk about later. So we'll talk about platinum pretty soon. So thank you so much for coming on. I really appreciate it.
I appreciate you, man. Thanks, man.
Awesome. With that being said, guys, the Economic Ninja is out.